Mark Matthews joining us this morning. Mark, good to have you with us. It looks like all the signals are stacking up, whether it be globally or back home, and the fund flow picture also improving. First, just give me, the context that you're looking at, how positively perhaps, India is positioned currently in the overall global environment, given the kind of flows that we've started to see resume.
Okay, so I think the major thing that's happened over the last 2 weeks is there's a growing sense that the global economy will be picking up. And the reason for that is that leading indicators have turned positive in many places in the world. For example, the Philadelphia Semiconductor Index typically leads the U.S. Purchasing Managers Index, and that has risen very sharply. But there's a whole bunch of other ones too. And PMIs generally, they seem to be troughing and rising now. And I think it's a function of all the central banks that have cut interest rates this year. So we know, of course, the Federal Reserve has cut interest rates, but there are 25 other central banks that cut interest rates this year. And the ECB started quantitative easing in September, and the Federal Reserve started quantitative easing in October, in all but name only. So anyway, there's a sense now that the global growth proxies are the place to be. And I'm not sure if that includes India, frankly, because India's economy is seen as largely a domestic one for good reason. I think exports are something like 18% of GDP. So people have been looking to places that are more highly correlated with global growth in India.
Okay. Fair enough. So, when we're talking about looking at growth in India, Mark, we've had some differing comments coming in there. What do you feel is the general consensus? Because on one hand, we've had all the right moves, whether they be incremental, but nonetheless, in terms of policy making by the government. On the other hand, we're still looking out at that divestment agenda, looking for something to really kickstart things as well. What is your view on this?
I think we probably saw a bottom for the economy in the most recent GDP print at 5%. And I imagine that by the end of the year, we'll get back up to around 6. It's not going back up to 8 like it was a few years ago. But I do think that it does take time for things like interest rate cuts and tax cuts to flow through into the economy. And I do think that they will. So I'm not seeing a V-shaped recovery, but I do see a recovery. I do think that things will be progressively better over the next 6 months.
And Mark, what would it have to take from the government's end or from the central bank's end to really ensure that the market as well as the economy stays robust? Would you say that it would have to be a series more in addition to what the government has already done with regards to real estate, corporate taxes, what have you? More reforms? We've got the budget just in about 3 months, and there is a lot of chatter that maybe some tampering with regards to a capital gains tax, or for that matter, the capital gains tax is actually going to be eliminated completely altogether. Some lowering of personal taxes as well could be in the fray. Do you think a series of more measures would be required to ensure the growth kicks in and the markets remain happy?
To me, it's actually a bit of a mystery why the private side is so weak. And it's often blamed on demonetization and the GST. But those are getting to be quite far in the rearview mirror already. So I struggle to answer your question simply because I myself am a bit flummoxed by the very weak private sector investment and weak consumption. If I don't know why it's happened, I can't give you any strong guidance on how it can be improved. So I struggle to answer that question. I apologize.
Fair enough. Okay, so Mark, where do you see growth coming back first then? In an ideal scenario, and given what we do know, how buoyant do you feel we'll see growth resume, whether it be in really troubled sectors like real estate, which we just heard about last week, whether it be on the banking and financial front or across the board? Where are you looking?
I think in the private banks, there is an opportunity for growth simply because the NBFCs are clearly saddled with a lot of problems now. They're not going to be making any new loans. And the big public sector banks, I don't think have enough capital to make a lot of loans either. They're being given enough to keep floating, to remain stable. But there is an opportunity now, I think, for the private sector banks to grab market share, and it's quite encouraging that we can see, the individuals lining up to recapitalize some of these private sector banks, like Yes Bank, for example. So that would be a space I would focus on.
Mark, increasingly there is this debate back home about whether you chase quality or do you chase growth. Now, the problem is that what we define quality as of now has come in at a very, very expensive valuation. Companies like a Bajaj Finance, an HDFC Bank, or for that matter, even a Nestle, which continues to outperform the basket. But yeah, the valuations are exorbitant. And many believe that it's time now to move out of these expensive quality names and maybe look at the lower end of the band, wherein there is growth and valuations are a little reasonable as well, because it's these, the most sought after names which will continue to be expensive and may not give you that kind of growth numbers for, say, the next decade or so. Do you also believe the time has come to maybe move out of this expensive 10 and look at the other end of the market too?
Hard to answer again, I apologize, but I would say that quality is almost always expensive. The only times you will not find it being expensive is in crises and recessions, and we're clearly not in one of those now. So, and then you have the very rare chances, which I would say only come around like once every 10 years to grab a really top quality stock at a low price. Otherwise, you pay for what you get. They are expensive because they're well run, because they have a history of treating minorities with respect, because you can be assured every year there will be perhaps not the strongest growth, but good solid growth. So that kind of portfolio, I think, should always form the basis, the core of people's holdings and equities. Growth has been on a huge tear globally, and I would say that's largely a function of low interest rates. And the lower interest rates are, the more capital there is just flowing around the world that is seeking out returns and willing to finance riskier things, which growth companies usually are. Now, a lot of people thought that the debacle with WeWork and these poor IPOs in big companies, the ride-hailing apps like Uber and Lyft, was somehow portending the end of growth because they fared very poorly. But I don't think so, actually. I think that we're still in an environment with very, very low interest rates, and therefore, to answer your question, I think holding a bit of both is the way to go, because quality is safe and steady, probably should be the bedrock of one's portfolio, but supplementing it with growth in this kind of environment where interest rates are going to stay long for the foreseeable future is not a bad thing to do.
I wanted to get in your perspective on the earnings as well. Now that we're pretty much done with Q2, what's the expectation of the earnings growth in the coming quarters in light of, the economic scenario that you painted out, the fact that we've spoken about the corporate tax rate cuts? Are you seeing a significant improvement in the earnings picture?
I think around the world, this will be the major test for the markets, is around the world, not just in India, but in Europe and in the United States. There is a consensus expectation that growth will rebound into the coming quarter. So let's see if it does. That's a bottom-up analysis on the part of the analysts. The top-down, specifically with India, it's harder to see these bottom-up forecasts being met. The top-down would indicate EPS growth this year in India, maybe somewhere around 5 to 8%, whereas the bottom up is still showing. In other words, the aggregate of all the analysts expect somewhere, I think, about 12 to 15%. So anyway, I imagine it'll be probably closer to those mid-single-digit numbers.
Do you believe that, when it comes to the housing finance companies, that sector as a whole, we have seen, due to the liquidity concerns, that sector has been through quite a bit of turmoil? You believe that the weakness here is likely to persist?
Yes, I think so. These kind of things take a long time. I think you could almost call what's happened in the sector a crisis, or at least a mini crisis. And typically, when you get a big decline in a price, it has to build a base, has to go sideways for a while. And I think there's still a lot of skepticism toward the space too. So I think at least 3 to 6 months of building a base before you can see a move higher.
Okay. Mark, anything that you'd clearly stay away from currently as well? Any sectors or pockets that you feel are still looking a little weak, or that you're just not sure of the trend?
Well, the only thing I would say is that if there is a global recovery impending, and I think there is, I think we're going to see signs of that within the next 3 months. And the trade war between China and the U.S. is thawing. Actually, the one thing that doesn't benefit in this kind of environment is gold. And there is a record amount of money that has gone into gold in the last 6 months. So I figure gold probably needs to cool off here and come down a bit more. That'd be one I would see more price downside in.
At a 3-month low, that's where gold is in today's rate as we speak right now. Mark, great to have you on the show with us. Thank you so much for taking the time out.